Good morning, everyone, and welcome to this month's Market Insights. My partner in crime, Temi, is dealing with a little injury to the line of duty, so I think she will still be joining us today, maybe a little bit late, maybe popping kind of in and out. So just wanted to let you know that. For those of you who are new or, hold on one moment, there we go. Welcome, Temi. Good to have you on here. All right, for those of you who are new this month or watching on YouTube later, I am Paul Nalabondian, your local market expert. I'm an attorney licensed in the District of Columbia and a top producing realtor licensed in Virginia, Maryland, and DC. I and we are both realtors on Fulcrum Residential, one of the top real estate teams in the country, and we are proudly affiliated with Keller Williams Capital Properties. We are about to get started. We're going to run through everything that is important in the local real estate market and the economy as it relates to the real estate market and mortgage rates. And specifically, we will be discussing those mortgage rates. My wonderful colleague, Temi Koji. Temi on the break. Never one for long introductions, but nonetheless, I want to give you the opportunity each month. Temi, would you like to introduce yourself to the folks at home?
Hello.
There we go. As succinct as always. All right, hold on, let me get me centered here.
Don't forget your coffee.
Thank you very much. I was just not centered on there. All right, going to switch over for just a moment. Coffee of the day today is from Hydrangea Coffee Roasters. They are out of Berkeley, California. This is an El Sorocco Gesha. El Sorocco is one of the most awarded, respected coffee farms in the world. They're in Guatemala, and this is an incredibly delicious washed geisha. We have notes of white peach, white hyacinth, and Meyer lemon, I would say. Let's see where those notes are coming from. Very delicious. Okay. Now we will get back to the task at hand. We're going to cover the same format we cover every month. If you are new, we'll give you a quick rundown. We are going to start off looking at mortgage rates, specifically what mortgage rates are, where they've been, where they might be headed, what they are for the various products. Then we're going to take a deep dive into the national economy. And the reason we do that is because that's what determines where mortgage rates are at and where they're headed. We're also going to look at the conflict in Iran, the implications of that. And we're going to take a closer look at the DMV economy and have some GDP numbers and updated unemployment numbers related to the local economy there for you a little later today. After that, we're going to jump straight into the DMV real estate market, where we will look at the most recently reported month from Bright MLS, which is March. We're also going to look at the data so far available in April, and I pulled a little extra. We're meeting a little later in the month, this month, and wanted to cover more of what's been going on in April. Would love to hear where everyone is joining from. If you're a realtor, let us know where you're licensed, where you focus your practice. If you are thinking or planning on buying or selling a home, would love to know where you live, where you want to live, and also if you have any particular concerns or questions that you would like covered either now or later, please drop those in the comments. Great to have you with us. We have Keller Williams Capital Properties. We have Virginia, our wonderful principal broker. Fascinating. Not sure who that is, but looks fascinating. Great to have you on here. And newly licensed agent in DC. Okay, still seeking a brokerage. Well, I'm a little biased, but I would recommend you look at Keller Williams Capital Properties. Incredible training, incredible support. Just really like it. So recommend you at least take a look. Casey Baxley, who is on here, can get you started down that road. Also, welcome John Coleman, Coffee with Coleman. Great to have you on here. Always wonderful to have fellow top producers. And that just allows us to get more insight into the boots on the ground, micro, what is happening right now at a level that I can't pull data for. So super, super helpful. All right, let's get started. Mortgage rates. Where are mortgage rates at? I will tell you what's recently been reported. I can also tell you that What my clients have locked out recently, I would love to hear everybody here in the chat. If we have Mark Lenkowitz, our lender partner with Envoy, if you could please share what your clients have been locking in lately, and any of the agents here, or if you're a home buyer who has locked recently, if you could let us know what rate you have locked at. Please also mention at least the property type, because mortgage rates do vary between, fee simple, detached row homes, and condos. And then also, if you want to mention how much you put down, you can do that too. You don't have to, but that can also affect 675. Okay, Christina, I'm curious whether that, I'm thinking that might have been a condo, but appreciate all of the info there. All right, so mortgage rates, these are where they have been at basically for the past year and change, pretty much right around where they were when we met last month. In the interim, you can see, we'll pop ahead to this. In the interim, you can see there was a decent little spike, went up into the 6.6s. Now they've since dropped down. They're right around 6.3. Wanted to have this slide in here just to make clear what the conflict in Iran is doing to mortgage rates. You can see I have the line there at February 27th, the day before the strikes began. Mortgage News Daily was reporting 5.99, rates into the fives, albeit just barely. Since then, there's been a noticeable and meaningful increase. Right now, as of that's actually more recent than March 18th, but we're right around 6.3 for the 30-year. We're looking a little bit lower than that, 5.92 at the 15-year. Jumbo is around 6.5, and you can see the other products there. I want to run back to this just for a moment, and so rates are right around 6.3. Like I said, now they've popped up to 6.6. And we've talked before about how, and this is one of the reasons why I have this band going back to 2022 when rates first began their initial ascent. We have been in since September, outside of a brief little pop up into above 6.5 in late March. Since September, we have been in this 6 to 6.3, 6.4 band. That's the longest time we have been at rates that low since they originally crossed that threshold in 2022. So it's still a wonderful time to buy. If you were thinking of buying a home, still a great time as far as mortgage rates and all things considered. We'll go into a little more detail on that. And then also, if you're an agent, it's just important, that you're communicating that to your clients. Still a really good time to buy. This could all change, though. I want to make clear that the rates where they're at right now is the market expecting this conflict to resolve sometime soon. And I expect that as well. But if that doesn't happen, we could see rates go up, and we could see them go up rather dramatically. Can we see anybody else there locked recently? If you could throw your rates in the comments, that would be wonderful. How are people feeling about the economy? And if anybody wants to chime in on the comments, I'm not going to go into a ton of detail on this again, because I've done it for 20 straight months prior to last month. If you're watching this for the first time, want a little bit more detail, go to one of my sessions a few months back. There's a table of contents. Look for the section of why I talk about the economy. In short, I talk about the economy because the economy is what determines mortgage rates. Mortgage rates are packaged into mortgage-backed securities, and they are traded on the bond market with other bond products, basically debt instruments with a fixed rate of return. And depending on what's happening in the bond market, that will affect what yields mortgage-backed securities need to have in order to be competitive on the market. When things are going better, you can offer a lower rate, you can have lower mortgage rates, and still have a competitive product in the bond market. That's why we talk about all of that. And the more you understand what's going on under the hood, the better you can understand why rates are at right now, where they're headed, and what might affect them in the interim. Okay, GDP growth. Since we met last month, the third estimate for Q4 GDP came in at 0.5%. That had been revised down. The initial estimate came in at 1.4. The second estimate came in at 0.7. Third and final came in. They can always revise it later, but consider that a fairly accurate number. 0.5% of GDP increase. And just want to note here, I'm feeling a little bit vindicated because I've been talking for a while about how GDP projections were just not making sense to me, because all of the metrics underlying the economy, all of the information seemed to indicate that things were faltering just a little bit. Now we're seeing these play out in the numbers. And this, you can see Q4 2025, obviously that pre-Iran conflict. Iran conflict is doing some damage to the economy as well, but you can see the economy was already softening up by a meaningful amount over Q3. Thank you, Shakura, for 6.5. Very nice. Good rate. And John mentions that the economy has slowly improved as the news cycle has stabilized. We'll see if that continues. Yeah, it's really the I've said before, and we'll talk about also briefly here. The conflict in Iran has such a powerful impact on the economy and can have such a powerful impact on the economy. The reason why things are semi-stable right now is because expectations are that will resolve itself somehow relatively soon. If that doesn't happen, the actual impact to the economy will be and can be massive. All right, going on to Atlanta now. They have a GDP model. Want to note something interesting? The Atlanta GDP model, it doesn't add color to its projections. It doesn't have like human beings, to the best of my knowledge, like just adding context to this based upon what's happening. All they do is take specific metrics, plug it into their little machine, and produce an estimate for GDP. Just want to note here, if you take a look, you can look like basically right before the conflict started, their estimate for Q1 GDP was above 3%. And it's taken a nosedive since then. Right now, it's 1.2%. So since the conflict has started, their estimate for Q1 GDP dropped to a third, which is one of the most dramatic drops I've seen in their model in a short amount of time in quite a while. Talked about this in more detail. Touch on it again really quickly. What is the impact of the Iran conflict? What is the possible impact? And it is, if you want to distill it down to its simplest essence, it's oil prices. It's more than that because there's also a lot of fertilizer, other types of fuels related to that. Just all sorts of trade that goes through the region will have cascading negative effects. But if you just want to focus on one thing, you could say it means higher oil prices. When you have higher oil prices, you have higher gas prices. You have higher gas prices. You have higher prices and everything else, which means inflation adds stress to the economy. Higher inflation means higher treasury yields, means higher interest rates, more stress to the economy, higher recession risk. And if this conflict is prolonged, you will almost certainly have stagnation in the economy, where the economy just kind of slows down to a grinding halt, and you have inflation. That's the worst of all worlds, where you have prices going up, but production and the economy going down or being stagnant, and none of us want that. So if this continues, worst case is a catastrophic global economy. I don't expect that to happen. The political cost would be too high for this not to be resolved somehow. I've said a while back, and this is just total speculation, but it's like I expect if this thing didn't get resolved, that we'll see Marines on Karj Island, and that will be a major point of pressure on the regime there. But we'll see. One way or another, I expect this to be resolved because, like I said, just the political and economic costs are too high if it is not. Now, if I sounded a little bit pessimistic about the economy, would like you to know that I am not alone here. General consumer sentiment is pretty bad. The two most respected consumer sentiment surveys out there, University of Michigan, they recently reported their latest findings. Consumer sentiment had dropped to the lowest point in the history of their survey, which the beginning of that survey predates most of us on here. So that's been going for 70 plus years. April came in even lower than the low amount most economists expected. Then we also have the Conference Board's Consumer Confidence Survey. Now, interestingly, this survey, the general consumer confidence actually inched up just a little in March. So according to them, people thought things were doing a little bit better than they were in February, but the expectations index of where people think the economy is going is dropping, and it's getting to alarmingly low levels. It's the lowest level right now we've seen in 12 years. And then also the level is 70.9. And I know that doesn't mean anything to anybody, but just know that when the expectations index is below 80, that's considered a leading indicator for a recession, and it's been below 80 now for 12 plus months. Okay, now we are going to take a closer look at the DMV economy. And as most of you know, DMV, because of the federal government layoffs and some other things, has been hit a little bit harder than most of the rest of the country. And it's becoming clear that we've been hit a lot harder, like just a lot harder. I don't know if everyone is feeling it out there. There's still a lot of wonderful jobs in the area, and if you've maintained your employment, a lot of things probably haven't changed too much for you. But just want to note that outside of Northern Virginia, unemployment for the metro area is higher everywhere else. Excuse me. So DC proper unemployment is 6.7%, and that's the same as it was in December, but elevated as to where it was beginning of 2025. DC Maryland combo region unemployment is at 5.6 as of January. That was up from 5.1 the month before. Interestingly, I mean, as you can expect, if DC held the same, but DC Maryland went up, the cause of that is Maryland. I went into all of the major counties in Maryland, and every single major county in Maryland had an increase in their unemployment rate. Northern Virginia has a lower unemployment rate than the country. They're at 3.7 as of January, but that is rising, and it's up almost 1%, almost 50% increase actually in the past year and a half. So Virginia still doing relatively well, all things considered, but their unemployment is rising fairly dramatically. And okay, what does that mean? We have higher unemployment than the rest of the country. Like, it's hard to gauge what that really means, or relative to others, how we're doing. So I think this is a helpful graphic. And this is a graph, it's from the Bureau of Labor Statistics. And to them, this represents every area in the country that they felt had a statistically significant change in employment over the past year. So this chart consists of all areas in the country that they feel had a meaningful change in employment over the past year. Excuse me. If you look, blue means positive increase, orange, yellowish means negative increase. That giant bar at the bottom is us. That massive bar at the bottom. So you can see as an area, as a metro area, we have lost significantly more jobs than anywhere else in the country. And it's not even close. And then to put that to a percentage, you can see here, this is the percent change in total employment, the total non-farm payroll jobs. They always pull out farm out of this. But by area, you can see that from December 24 to December 25, our area employment went down by more than 1.5%. Most major areas in the country were up 0.25 point, and then the country as a whole was pretty solid. And as long as we're at it, we'll touch on area GDP briefly. This chart shows GDP for the local area for the past 3 quarters. And you can see that DC is a orangish color, Maryland is a vibrant teal, and Virginia is a yellowish orange. I didn't choose the colors. But there's no such thing as a regional recession or a local recession. A recession, by official definition, is when NBER, the National Bureau of Economic Research, says there is a recession, and it's always backward looking. They always, once enough data has been released, they look back and say we were in a recession from this period to that period. They don't do that with regional areas. They don't do that with cities. If they did, if there was such a thing as a regional or an area recession, I would contend we are absolutely in one. You can see here that Q4 GDP for DC dropped by 8.3%, Maryland dropped by 3.3%, Virginia dropped by 1.8%. So much worse than the country as a whole. So you can see that our economy is dramatically contracting, and I would expect there's nothing to indicate that this trend hasn't continued into Q1. And it's always helpful. I love it with, thank you for the contribution, Casey, that we tie it back to how can this help us in a meaningful way for those of us who are agents. And it is, Casey mentions it. If you haven't talked to your people, if you haven't talked to your friends and family and people in your sphere, you know, people in your pipeline lately, it's a really valuable time to do so because there's a lot of change, there's a lot of uncertainty, and no one can predict what is going to happen in the future. But you can understand what's going on and speak intelligently about what could happen and how it could impact the real estate market. Okay, going into the consumer price index, inflation. And I just mentioned about understanding this can help you understand where things are headed. And I just want to note, not never want to be like an I told you so, but it is kind of fun when I did tell you so. And one of the things I mentioned last month is I said the conflict in Iran is going to push up inflation, and it just depends on how long the strait is closed, what that does to oil prices. I said that economists generally say that every $10 increase in a barrel of oil will increase inflation by 0.2%. So we had an increase in $30 a barrel in oil, and then we had month over month inflation last month was 0.3%. Then this most recent reported month was 0.9%, a change in 0.6%, which is 0.2 times, basically. So when you run the math on the projection I gave as far as where inflation is at now relative to oil prices, it hit spot on. And so I just mentioned that to know that the more you dig into this stuff under the hood, the better you're able to see. You're able to see a clearer picture of where the economy is headed, where mortgage rates are headed. And that is true. But then I also want to note, and this is one of the reasons why things are so unpredictable right now, and no one can really say what's going to happen because it depends on what's going on with this strait. So I want to read a quote from the or I have a quote that I'm going to read from a Federal Reserve governor recently that says, the impossible or the conflict is impossible to predict what's going on in the economy in light of that because we just don't know what's going to happen. And that is true. But if you understand what underlies mortgage rates and the general economy and the real estate market, then you can understand and speak intelligently about if X happens, then Y. If Z happens, then. And you can at least be aware of kind of that causal chain and causal impact. The 0.9%, just want to note that that's the largest month over month increase since June of 2022. So that's the largest jump in about 4 years. Energy prices made up almost all of that, which is worrisome because there hasn't yet been enough time for all of that tertiary kind of tangential, I said, where energy costs go up, transportation costs go up, the cost of everything goes up. There hasn't been enough time yet for that to happen. So this is largely due just to simply an increase in gas prices, increase in energy prices. If the strait remains shut down, we're going to see these numbers get a lot worse in the near term. And then 12-month year over year, all items that went up to 3.3. It had been at 2.4 for the prior 2 months. This is the highest annual inflation in 2 years. So not as bad as highest in 4 years, but not so great. And ever so briefly, for those of you who have been with me every month, you know that I've talked about different cell imputation for a while. I won't go into that same level of detail, but in short, the Bureau of Labor Statistics does not have as many enumerators, price checkers as they have in the past. As a result of that, they're not able to kind of fully do their job as it relates to collecting information for inflation. The consumer price index is made up of actually pulling specific prices for specific things in specific regions. When they can't find a specific price of a specific thing in a certain area, they try to find the price of something similar in that area or the same thing in another area. When they do that, when they make this educated guess, they call it different cell imputation. Prior to around this time last year, the number of guesses was less than 10% going into the CPI. So it was like 90% of the CPI was based upon concrete data, actual things at actual prices in a specific area that was intended to be observed. Since then, it's gone up. We've been in this 30 to 40% range for quite a while. So basically, about half of the data that goes into CPI is educated guesses. So take that for what it's worth. And Maggie asks, great question if DC is underperforming the national economy. What early sign should agents watch for us to understand, whether it becomes a housing correction? And really just continue to look at median sales price, look at the supply versus demand calculus, look at days on market. We're already seeing days on market creep up, but really just you're looking at all the things that go into that supply demand calculus or that inform you about that. And if things start to decline in a meaningful way, then you'll see demand lessen and you might see supply increase. Kind of depends on what people need to do. If there ever is this kind of exodus out of DC, you could see supply increase in a meaningful way. And if demand decreases, then we could just start seeing homes sit on the market longer and higher inventory.
Yeah, and I'll say also say like the spring market is going to continue to be the spring market. I'm seeing homes that have been on the market literally for 4 to 6 months, have multiple offers. I just had a home was on the market 128 days. Client saw it for the first time. They had 4 offers, including a cash offer that went over asking. The spring market is still the spring market, regardless.
hmm Thank you, Tammy. I'm glad you mentioned that. We're going to talk a little bit more about that in a bit, about how there's still a fair amount of properties getting multiple offers. And right now, the spring market had a little delay ish or a hitch in its start, but we now appear to be in a very vibrant time of the market. We'll talk about that when we hit April data. All right, jobs really quick. Added 178,000 jobs in March. You can see this was a huge bump over our net loss last month. We've had a lot lower numbers recently, but just keep in mind, more than half of this total was healthcare and social assistance. Healthcare is a defensive sector. That's going to do fine regardless of how the economy is going to be doing. And, healthcare and social assistance is helping people in need. So a bump in those jobs doesn't necessarily mean things are going great. Unemployment rate was down to 4.3. Briefly going to go in a little bit more detail on this because I've been talking about the soft jobs market for a while and how that should worry you because a strong jobs market is the biggest buffer we have against recession. When you have a weaker jobs market, it doesn't take much for the whole economy to really make a meaningful decline. But I want to add some color and context to that because a lot of economists think, and there's actually a data piece provided by the Dallas Federal Reserve that breaks this down in a little bit more detail. But in the past, the consensus was we needed to add, in the recent past even, we needed to add 50 to 150,000 jobs a month just to break even with the labor market because we have an increasing population, increasing participation in the labor market. And as a result, each month we need to be adding jobs in order just to break even. But there are two things going on right now. One's been going on for a while, one is more recent. We have the baby boomer population, which in 2008 started going into retirement, is continuing to go into retirement. And that is taking a lot of participation out of the labor force. And then we have what's expected to be a net immigration to the United States of 0 this year, which is lower than it has been recently. Because of that, respected economists think that now our break-even point for the labor market can be around 0. So you can have a steady labor market where we're not adding jobs each month. And so in light of that, you can't look at these jobs added the same way as you used to, and that you can have numbers like we have had. Get back to this. You can have numbers like we've had recently and still be a relatively healthy labor market. And I want to say that is absolutely true, but also you should note we are in a very precarious situation with our labor market. We have been in this low hire, low fire situation for quite a while. Employers are still feeling a bit stung from the pandemic when they needed to hire people. There was a labor shortage and it's really difficult. So they're very reluctant to let people go, but they're also not hiring anybody. People, if you're unfortunate enough to be looking for a job right now, unemployment is stretching on longer. And a lot of people are stuck in, there was a survey recently of people's satisfaction with their current job and their current income. And it's at the lowest level it has been in quite some time because a lot of people don't have options to move to another job. And those out there who don't have jobs are having trouble getting new jobs. So it is true that it takes fewer jobs for there to be a stable labor market, but it is also true that we have a very precarious labor market. And now I just want to go back to Federal Reserve Governor Waller said in a speech recently, and this is I thought this was wonderful. So he said, what happens next? This was just given last week. And he's like, what happens next in light of everything going on and the Federal Reserve and what do they do? And he's like, let me stipulate that I believe economic forecasting is hard, even in normal circumstances. I'm tempted to say it's like batting averages in baseball, where an excellent result is failing 2/3 of the time, but that wouldn't be fair to baseball because we forecasters have an even lower rate of success. Anyway, add a military conflict in the Middle East to the task of predicting the course of the economy, and things get very complicated. So he's basically saying that in light of the current conflict, nobody can say what's going to happen with the economy. Nobody's going to say what the Federal Reserve will do because you just don't know. And it can vary so much. Okay, moving on. Federal Reserve, they met right before we met last month. They're going to meet again next week. What's going to happen at the meeting? Absolutely nothing. Absolutely nothing. Zero chance of a rate cut right now. And continued tracking, we're just keeping an eye on. Very important to the maintaining the independence of the Federal Reserve will be what happens in Trump v. Cook, and also what happens with the criminal investigation of Chairman Powell. Trump v. Cook Supreme Court decision is expected in June. All right, now this is just interesting. Wanted to show the Federal Reserve of Atlanta has a rate probability tracker. On February 27th, the day before the conflict started, they predicted a 40% chance of a rate cut at this meeting next week, and a 5% chance of a rate hike. As of yesterday, it inverse 4.5% chance of a cut and actually a 12% chance of a rate hike. And there's, I think I saw some expectations now. Right now, the market is pricing in. They're expecting no more rate cuts for the year, and they're expecting there could be a rate increase in 2027. Take that for what it's worth, which is not a whole lot because it all depends on what's going on overseas. 10-year Treasury up a bit. It was 4.2 when we last met. Obviously, everything I've talked about, it's natural. This is going to be increasing. Retail sales. February and March data was released on Tuesday. The March sales numbers look great. It's the biggest rise in 3 years, but the majority of that increase, and this is why you have to understand what's going into this data to make any sense of it. The majority of that increase in March was just due to higher gas prices. So, yeah, I mean, if gas goes up, people still have to drive. We're heading, going from the winter into the warmer months. People drive more anyway, and your numbers go up because more money is being spent on gas. Added to that, with higher inflation, higher prices in general, part of this number is just other things costing more. Industrial production and manufacturing, both of those dropped. Not going to go into too much detail on that. All right. Now we've got almost a half an hour for the DMV real estate market. What's happening right now in the DMV real estate market? Temi talked about her experience with multiple offers recently, and that absolutely is happening. I've experienced that recently in multiple areas, basically in all, Virginia, Maryland, Montgomery County, and DC. And DC, the softest market on paper in the area. I've been involved in the past week and a half, 2 weeks, 3 multiple offer situations in areas that have higher days on market. Their median price numbers aren't that great. So you're seeing kind of a difference between the haves and have-nots. The great, wonderful turnkey homes are relatively, generally going relatively quickly with multiple offers. And some of the homes that aren't so great are sitting quite a bit longer. Yeah, Virginia mentions that mortgage rates will most likely kind of stay where they're at in the fourth quarter, and home prices continue to go up, and that is so true. We'll take a closer look here at where home prices are. First, just want to mention what we're on track for. And this will rebound. I think it's rebounding already at the end of April. We're seeing the end of April be more vibrant. But right now, we're on pace for 48,000 transactions. And if that maintains, that'll be the slowest real estate market in the area since 2008. Not sure if anybody was on this call was in real estate in 2008. But if you were at least 10 years old, you probably remember what was going on. And none of it was good. Global economic recession, caused in large part by subprime mortgages. I was in practicing law at the time, but I knew things were bad when our clients stopped paying for lunch. They stopped paying for lunch, and then saw a bunch of my colleagues and friends getting laid off. But I knew things were really bad when the firm stopped offering their free fruit bowl on Friday. So takeaway of that is if anybody's offering you free fruit right about now, I highly recommend you take advantage of that. All right. Other thing to note, takeaway before we move on here, 48,000 transactions. That's still more than enough for every agent on here to have a very vibrant business. And it's also enough to where every buyer you have can find the right home and sellers can find buyers. So it's not the roof is not crashing. Everything is still fine. It's just slower than it is normally. Now, going back into what Virginia was saying about buyers maybe not wanting to wait, you can see here now we had median sales price appreciation for March. We are now at 34 straight months of median sales price appreciation in the DMV. And as I said, mortgage rates have kind of been in this steady band where they have been at. With oil prices increasing, even if things get resolved in the conflict in the Strait, there's no way they're going to go down a meaningful amount anytime soon. It's just impossible right now with the lingering effects of higher oil, higher energy prices. So essentially, you have a situation where it looks like prices are going to continue to rise. They've risen every month for almost 3 years. And mortgage rates, you're not going to get any more mortgage rate relief. And there's a decent amount of supply, or at least more than there has been recently. And so it really is, that's one of my prime takeaways, an excellent, and it is like an excellent time to buy. And then Christina mentions, it's the TC condos have typically been the weakest segment of the market. Christina mentions that she's aware of a condo that one of her buyer clients was interested in, and it went under contract sight unseen. And that was going on all the time in 2020, 2021, but now not so much. But we are seeing an uptick in demand. So the two constants in the real estate market right now, mentioned median sales price going up year over year every month. The other one is days on market increasing. Days on market increased 11 days, still very, very quick for March, but that's now the 21st consecutive month that we have had monthly year over year increases in days on market. So even with relatively constrained supply and prices going up, homes are taking a little bit longer to sell in general. But, half of all homes going under contract in less than 2 weeks. That is a pretty quick clip. Both closed sales and pendings for March were up by around 5%. It's what we expected with the government shutdown ending, heading into vibrant spring. I expected us to see these monthly year over year increases in pendings and then close. And what I would have said, though, a week ago was that it looked like we had completely stalled out in April. The first 2 weeks of the month were not that great. And there's some reasons why that was. But we've seen the third week in April was really, really vibrant. And I'm thinking this last week will be pretty big. And we'll see April numbers come in strong. And I'll give you some specific numbers related to April in just a bit. New listings here. So new listings, they were down 12.8% in February, not down as much, still down a meaningful amount. And we'll see that was consistent across counties as well. Active inventory, though, still up overall. And we've been seeing this now, kind of the same old, same old. We've been seeing active inventory up DMV wide now for about 2 straight years. But just note, it's still at the lower end of where we've been at in the last 5 years. So more inventory than we have had very recently. But new listings, active inventory, we're actually, at the higher end of where we've been at for the last 5 years. But what I would consider kind of a normal level of inventory pre everything going on, pandemic, mortgage rate drop, all of that, constrained supply, we are still below those levels. All right. Detail of everything we talked about when you get the deck. Now we're going to take a closer look at county data. This is always where things get a little more interesting. Median sales price saw a bit of variance, kind of consistent across the board, except in Loudoun County and in Alexandria. Loudoun County, just the level of new construction, I always kind of discount what's going on there because you take the numbers of the whole as a whole, and it doesn't necessarily tell the whole story. Last month, I talked about how Arlington being down didn't necessarily make sense. This month, it's kind of the same with Alexandria. I looked under the hood in Alexandria, and it seemed like it was just, so a couple fewer $5 million homes sold in Alexandria this past month as they did the prior year. And that moves the needle a fair amount. DC and Prince George's County rebounding. Both were down last month. Both are up in median sales price. this month. And what Virginia said is absolutely true. Tale of two markets. It's just I don't know if there's ever been more of a divide between the haves and the have-nots, the great homes and the results they get, and the not so great homes. And there's nothing. It's not an intrinsic thing. That is really the approach of the homeowner and the agent developing a plan of attack in order to how to properly position this home on the market. It's not set in stone. I have encountered a lot of homes from potential home sellers that would have been a have-not sitting on the market forever, and we make some meaningful updates at reasonable prices, market it in a thoughtful way, and end up getting multiple offers and under contract very quickly. So nothing is set in stone, but it is just taking the time to properly prepare a home for the market, excuse me, and properly price it is kind of more important than ever. Maggie asks, how do you reconcile rising prices with increasing days on market and seller expectations and buyer urgency softens? So those two, it really is just a reflection of constrained supply. And when you think about anything, so the more data you have, the more meaningful a data set is. And the smaller the data set, the more you can have anomalies. Like I mentioned, fewer $5 million homes selling in Alexandria, skewing the numbers. Well, when you look at national numbers, those are a little more meaningful from year to year and changes because you're just looking at such a huge data set. And so when you break it down smaller, it's more susceptible to anomalies. And so what we're seeing here is because of the constrained supply, you can have more anomalous things happening. All right, demand is softer generally than it has been in a bit, but supply is still relatively low. So it doesn't matter if demand is soft. All it takes is two buyers to be interested in the same property, and you're probably going to go above list. You're probably going to have escalation clauses. You're probably going to have people wanting to pay more for that property. So it doesn't take very much at all for these nicer turnkey homes to really go at higher prices that can then skew the overall median sales price. And at the same time, when you have homes that sit, they tend to sit for a while. And so it's not like you're not going to have a $500,000 condo in Arlington have multiple buyers interested and it bids up to $1 million. You're not going to have that. But you could have a $500,000 condo in Arlington that is overpriced and in poor condition and has some other issues that weren't incorporated into the price. And it could take 6 months to sell. It could take 8 months. It could take a year to sell. And so you have these properties that aren't going quickly. Obviously, in median, it's just the numbers. It's not the actual. It's the number of properties as opposed to the days being accumulated and turned into average. But it's just when you look at this calculus, you have kind of the less desirable homes bringing up the days on market, and then you have the more desirable homes taking up the median sales price. Okay, let's rolling on. Closed sales. Okay, not much of a surprise here. Generally, DC and Prince George's County have been weaker buyer markets. You can see now pendings were down before. You expect that to translate into closed transactions for the next month. Elsewhere, other than Loudoun, which I've mentioned, closed sales are disproportionately affected in Loudoun because of new construction. You could go under contract 1 month for construction that's not going to be delivered to 6 months. So it's not really the same time frame like here in core DMV. In Arlington, Alexandria, DC, a lot of times you're under contract, you're closed within 30 days. Not so much there. So that skews these closed sales numbers, but up everywhere else. New pendings, you can see. Yeah, Susan has a great point that you can have listings with multiple offers and not go over list. Terms are important. And that's something that I know we're, Fulcrum and other top agents I talk to are counseling our clients. It's like money is great, but if you don't get to closing, it doesn't matter. And that's always something we've counseled, but now it's incredibly true with things being a little more unpredictable. You just want to make sure when you get under contract that whatever that number is, you're actually going to get it at closing if the contract falls out. that's relatively meaningless. Okay, new pendings up everywhere except Loudoun and Loudoun. I look back to last year. That dip is more just about how their last March was exceptionally vibrant and new pendings. So that's still a strong market in Loudoun. Okay, showing level. Showings were up 3%. DMV wide. Pendings were up 5.3%. So that kind of tracks. Not surprising. Showings up everywhere except Alexandria. And they were down just a bit there. Then also down in Loudoun. New listings. This is where we looked at the overall new listing number that was dropping. And here you look specifically, new listings down everywhere except for Frederick, which was up last year as well. A lot of new construction in Frederick also. And then Prince George's County listings were up. I expect us to see this flipped in April. I would be surprised if we don't see every area in April with monthly gains year over year in new listings. And then active listings, excuse me, lately we've been seeing active listings up mostly everywhere. Not as much this month, but in light of the new listing data we saw, excuse me, that's kind of to be expected. So new listings last month, new listings were up everywhere except Loudoun and DC. Loudoun and DC were both down again, but also joined by Arlington and Fairfax, down just a little bit. Just keep in mind though, like I've been saying, like these places where there are increases in inventory, a 50% increase of nothing is still kind of nothing. And I didn't update this. I'm not going to update this every month, but I will, maybe once a quarter. And this is what I pulled last month, showing where inventory was at as a percentage of 2019. And you can see outside of the District of Columbia and Arlington and Alexandria, everywhere is still lower than kind of a normal inventory level. So everywhere is still dealing with constrained supply. And then Alexandria and Arlington, this number showing that they're 180% over 2019 inventory, 138%. That doesn't mean they have inventory now, because they don't, as we'll see. When Alexandria and Arlington were in a really, really tight, extreme seller's market. I think it was, what was it? Yeah, Arlington had less than a month of inventory, and Alexandria had 0.6 of a month of inventory. For someone new, what's the quickest way to tell if a market is actually strong versus just low on inventory? It's looking at the calculus of all of these things, just kind of looking at where pricing is going, looking at where days on market is going, looking at what new pending levels are doing. And all of that together will give you pretty good insight. And then specifically, you can use the MLS. So if you have a buyer that's interested in a specific property, or you are planning to put a listing on the market, you can do a specific search. You can go into wherever that is, drop a pin on it, do a half-mile radius, or whatever the most relevant geographic area is. Then you can pull it up. If it's fee simple, if it's detached, you can look only at detached. If it's a condo, you can look only at condos. If it's a one-bedroom condo, you can look at just one-bedroom condo, and then you can pull the data within whatever time frame you want and look at what is happening in that subset. And so taking the kind of the aggregate market as a whole, looking at the relevant county data, pulling in zip code, and then looking more local, that will give you a very good idea of what is happening in the market.
Don't forget, you also have the resource.
A little more under the hood. But
Sorry, don't forget, you also have the resource NAR RPR. So if you haven't logged into that, log into that.
I know sometimes you cut out for me, but not for other people. I didn't catch that.
Oh, I was just saying, don't forget, you also have the resource NAR RPR, if you can hear me.
Mm-hmm. Yeah, absolutely. Okay, I did hear that. Last comment on that, whether a market is actually strong or just low on inventory. I mean, you could say that if a market, it's as long as demand exceeds supply, it's kind of a strong market in that. As far as generally, when people talk about a strong market, it means homes are selling relatively quickly for good prices. Talk about a weak market, it means homes are sitting longer, maybe selling for less. And so anytime demand exceeds supply, it almost doesn't matter where that falls. It's more the ratio of that. And so here it's like demand is lower, but supply is even lower. And so because of that, we're seeing upward pricing pressure and all of that. Okay, now going to months of supply. And this is what I was talking about. So DC is a little under 4 months of inventory. Prince George's County at 263. Everywhere else is under 2 months of inventory. I mean, that's nothing. No inventory. DC is the only area that, by classical definition, is kind of in an equilibrium level, an even market. It's not even technically in a buyer's market when you consider, most people consider over 6 months a buyer's market. Everywhere else under 2, just no inventory. The median days on market, we're seeing those start to creep down. Like I said, overall, 11 days on market. More than half the homes in the DMV are selling in less than 2 weeks. That is incredibly quick. And then even DC and Prince George's County are getting down into the 30s again. You can see Frederick there at 24. Everywhere else is less than 2 weeks. And you have Alexandria, Arlington, and Loudoun, all the close in Virginia counties, they're a week or less. Now, a little more detail, as promised, about buyers competing. Keep in mind, this is for the Bright MLS footprint, so it includes, Philly and other areas. But they did a survey of properties with multiple offers, and we have all been seeing a lot of multiple offer situations recently. And just know that overall, this Bright survey shows that 57% of homes sold in the first quarter of 2026 had multiple offers. So the number is down from last year. Things are softening a little bit, but there's still more than half of all homes receive multiple offers that hit the market. And then, as you would expect, this breakdown is detached homes have the highest percentage of multiple offers, followed by townhomes and row homes, and then condos. That's not surprising. Okay, as promised, we got 8 minutes left. That is perfect. We are going to run in. I'm going to show you the first 3 weeks of data in April, and then I'm going to follow that with some manual data I pulled year to date up until the 21st at least. So this is when you're looking at this, April data is always skewed. Anytime you have a major holiday, buyer and seller schedules that doesn't fall on the same day each year, it's going to skew year over year numbers. Usually we use year over year numbers to even out the seasonal changes, because if you just look month to month, things are all over the place, but they usually follow a pattern. Last year, Easter was April 20th. This year, Easter was April 5th. And so because of that, it just naturally, if we had anything resembling the normal market, the first week of April this year would be much slower than the first week last year. And then the third week, the week that fell over the weekend where the 20th was, you would have a much more vibrant week this year than you did last year. And that's what we saw. And then you also, second week of April was also very weak. And I think that was more like uncertainty, conflict in Iran. So you can see here, first week of April, new pendings were down. They were almost even, down just a little bit. And then second week, down big, almost 10%, rebounding huge by more than 26% last week, third week in April. I expect that to kind of continue, for us to see a lot more new pendings here in the last week of April and see a bump up in the overall numbers. And then going back, new listings. So they were down new listings were down almost 10% the first week, then up big 16.6% second week, and up even more, almost 25% third week. As you remember, we talked about new listings were down in March. You should expect new listings to be up overall in April. And then showings, going back, down first week and then up big the next 2 weeks. Median days on market kind of hovering around the same time throughout this time frame, just right around 23 to 25 days. And then active listings were up a little the first week, 2-1, and then up more by 9% and 13% second and third week. Okay, now I pulled, since we're meeting a little later in the month, I just wanted to pull some specific data for April year to date. Just manually pulled this from the MLS. So far through the 21st, closed sales for the DMV are down 1.1%. I think that will likely, I think we'll see that as a positive number overall once April is said and done. Sales price to list ratio, interestingly, where median sales price to list ratio for the DMV for April so far is 100%. Right? Of course, some are going higher, some are going lower, but median, middle point, right at 100%. That's the same number as 2025. When you look at the days on market, those are continuing to come down as you would expect for the season. But interesting to note, if this holds up, we talked about 21 straight months of DMV-wide days on market year-over-year monthly appreciation. Right now, we're holding steady. Median days on market year to date for April are 7, which is the same as last April. So that would be a bit of a meaningful change in homes going a little more quickly, and that's also reflecting what we're seeing in the market. Have covered this before. Just want to note, if someone's new, that Bright is expecting closed sales to be up by about 8% this year. We haven't seen that yet, but we could be starting to head in that direction. All right, key takeaways this month. So I would say key takeaway is that overall, the market is holding steady-ish, but it's being supported by weaker fundamentals. And so if the job market cracks or if the strait remains closed for a more meaningful length of time, the real estate market could go south in a hurry with the rest of the economy. I don't expect that to happen, but it's possible. And then to help gauge that, in addition to just knowing whether the strait's open or closed, not that it's that simple, is just keep an eye on oil prices. There's the US futures index, and then Brent, which is international. Just keep an eye on those barrel prices, and you can see if those barrel prices go up, inflation's going to go up, mortgage rates are going to go up. If they go down, that's good for everything. Agents, more than ever, this is a skill-based market. You need micro market knowledge. There's a lot of variance happening from one neighborhood to the next, from property type to the next, price point to the next, and also condition. Condition's so important. So it's really important to have that micro market knowledge to really be accurate in your pricing of listings, and just keep an eye out for these forces that I talked about that could cause the market to shift in a hurry. And then buyers, I would still say arguably the best time to buy in the past 2 to 3 years. We're seeing increases of inventory, but we're also at the lowest mortgage rate band we have been at since rates originally increased in 2022. So combination of all of that, more supply, great mortgage rates, and then moderate competition generally. I mean, even people who've been in multiple offer situations, it's not like it was in 2021. So all things considered, great time to buy. And then sellers, it's still a seller's market. It's still a great time to sell. Outside of DC, which, like classical definition, it's more of an even market, but still in DC, great homes are going under contract relatively quickly. And there we go. Finished 2 minutes early. Just a little thanks. My info. If anybody has additional questions, you can just go ahead and drop them in the comments. If you want a copy of the deck, you can email me or text me. Temi, we have 2 minutes left. If anyone has any questions, anything that they were hoping we were going to cover today that we didn't, or if you'd like any wonderful insight that you would like to add, Temi, would love to hear all of that.
No, I'm just glad you touched base on the fact that, there's just going to be an uptick in listings in April. And yeah, that's it.
Yeah, I would be very surprised if once April numbers come in, if we don't see more listings, if we don't see a fair amount more pendings. And then I expect that so long as things stabilize overseas, I think we'll see a big jump. And if the conflict gets totally resolved, I think we can see some monster months in real estate in May and June. All right. Wonderful. Well, thank you, Temi. Great to have you on here. Thank you, everyone, for joining us. We will see you same time-ish next month, third Thursday. And yeah, just appreciate you all. Appreciate the contributions. Have a wonderful rest of your Thursday. Take care.
Hey, Paul.